Okay, so we are live. All right. Okay, so good evening, everyone. From Nigeria, good evening, and whichever part of the world you're watching this from, good day, good evening, good afternoon. Okay, so I'm officially welcoming you to our webinar on doing business in the US, and we are specifically focusing on assessing international financial opportunities, particularly with respect to startups from Africa. And with me, I have my guests who I'm excited to have with me right here on the studio, Lindsay Mignano and David Crane, Jason Crane, sorry, my bad. Okay, so I don't know, maybe you want to say something, or should I just read your bios, your profiles before we get onto it?
We can self-introduce if that's helpful.
Okay, all right, thank you.
Awesome.
Okay.
Hi everyone. Cynthia, do we have critical mass here coming in? I can't tell from the from my end. Should we wait?
Okay. Yes, they should be coming in slowly. We haven't seen anyone yet, but they'll be coming in.
Okay, all right. Well, then I'll start a little slower just to allow some people to trickle in. Hi, everyone. My name is Lindsay Mignano. I co-own a women and minority-owned corporate law firm for startups. My particular practice involves flipping companies when they come to the U.S. for venture financing. So our firm is called Smith Shaporian Mignano, SSM for short. These are the kinds of practice areas that we partake in here in the U.S. We tend to do formation or reorgs, this being like a reverse merger, which we'll be talking about today, corporate cleanup and preparation for financing, note and price round raises. And we also serve as outside general counsel to a lot of our startups, helping them with tech trans or commercial contracts works. And every once in a while, unfortunately, we have a founder fallout, and we'll help those startups with business disputes and partnership disputes. So we are a 6-attorney firm. We're based here in San Francisco. We have an office in Seattle and San Diego as well. So we are based here on the West Coast of the US. Hi, Emmanuel. Thanks so much. I'm going to be going through my portion of the slides first, and then I'm going to be taking it over to Jason. And hi, Vivian. I want this to be as interactive as possible. So I'm going to ask you if you have questions along the way to drop them. Go ahead, drop them in the comment section of the chat so that I can hopefully address them as I'm going along. Or maybe if not, I can come back to them at the end. So the first consideration, and I'd love to hear from the audience where you are in your journey. When an entrepreneur is coming to the US market, the first consideration to consider is whether the entrepreneur is coming here just to expand its service or product offerings. In other words, to open up generally a subsidiary to do business here in the US with other businesses, to scale its products, to get American market fit, or is the US company coming here in order to access American venture finance? For those of you in the audience, I would love to take a quick pause to see how many of you are interested in American VC financing. If you can just go ahead and put in the chat in terms of who you are, if you're a startup, what stage you're at, what your company does, and more or less if you're interested in accessing American venture capital, just so that I can kind of tailor my presentation accordingly as we go forward. Generally speaking, the good news is that $1.7 billion in Q2 2022 went to African-based startups. So that's a marked increase. It was in the first half of 2022. It was more than half of the total raised in 2021 throughout the entire year. And that's data from the CB Insights Venture Report for Q2 2022. So it is an incredibly frothy market for African-based startups. Those of you who are coming here to access venture financing as a goal would be really pleased to hear that. Now, generally speaking, the reason why I asked this question is because if the goal is to procure American venture financing, usually it requires a much more complex reorg. it's really called, legal terms, it's called a reverse triangular merger. Colloquially, a lot of people call it the Delaware flip. But it is something that you would have to do, you would likely have to do in preparation for some big money here in the US. For example, Series A, which starts at minimum 10 million these days here in the US. If you are just coming here to have a presence and to expand your service and your product offerings, you don't have to do this very, quote, expensive procedure. You can just create a subsidiary. Sometimes it's a Delaware C Corp, sometimes it's a Delaware LLC. You can create a subsidiary that is wholly owned by your African entity, and just through an intercompany licensing arrangement, license your IP from Africa to the US for distribution here in the States. So that's very common. It's something that can be done and set up very easily and very quickly. The second bullet point is, a little bit more problematic in terms of the kinds of steps that need to happen. So why would you want to come here to the US, aside from the stat that I just dropped, which is $1.7 billion deployed to African startups? Generally speaking, in the past, let's say 4 years, beginning 2018, the US has had a really, really, really frothy and great market for early stage startups. So seed, pre-seed, angel rounds, and I'll define those very shortly, but they were doing very, very well. So just ballpark figures here in the US based on current stats, how I tend to think about angel, friends and family, pre-seed, all of these terms kind of being interchangeable in some ways. I consider that anything where the total amount is raised, maybe 500 or 600,000 or less. At the seed stage, we can see anything from 1 to 5 million, with a priced round coming in generally around 2 to 3 million on pure stats. And then at the Series A, we're looking at anything minimum 10 million, with the average and the median being slightly higher right now, indicating a really, really robust Series A market. So that early to early stage, anywhere from pre-seed to Series A in the US has been really fruitful in 2018, 2019, slight dip in 2020 in the first half of the year, but really picked up in the later half of 2020. Banner market through 2021, and we're just starting to see a slight retraction here in 2022. So for the most part, that stage, and I'm not sure exactly what stage the group is in, but for the startups who are in that stage where they've raised maybe a little bit of money here in Africa, Nigeria, I see a lot from Nigeria, and are looking to access like larger either seed financing or Series A financing in the US, that market is still pretty good despite the public market volatility here in the US. And there's a number of articles that you can take a look at for the current stats. I really like the CB Insights Venture Report for quarter 2022, as well as the NVCA PitchBook quarter 2022 report. If you talk with VCs here on the street, there's a marked difference between what people are anecdotally saying and what the numbers show. So the word on the street is that, early stage financing is going to take a hit. It's going to be slower because of the public market volatility and the fact that later stage startups are not getting any financing. PitchBook in its report acknowledges that the stats don't quite show that. And the stats might have some time to catch up with the word on the street, but the stats are showing that, seed deal and below are tracking for the same 2021 highs, at least as of quarter 2, 2022. So there are some predictions that this will slow, but it hasn't been reflected in the data yet. And that's consistent also with the CB Insights Venture Report of quarter 2, 2022. So there is still, at least statistically, a very robust market despite some anecdotal stories of slowdown. In terms of what insulates these companies. So for those of you who are early stage, what's great about you guys is you are the furthest from the public market. So in the lifestyle of a company, this is where the baby is born. This is where the baby goes to IPO. Seed, pre-seed, Series A, we're all here on that market. IPO is here. The companies that are later stage are having, quite a rough time right now because they're closer to the public market. So they're not insulated from that public market volatility. Experts are saying that the reason why seed, pre-seed, Series A entrepreneurs coming to the US or who live in the US are are not experiencing that same level of slowdown is because they're farthest from that public market volatility. The second reason that a lot of experts are saying that this is still a very robust market for startups at your stage is because in 2020 and 2021, there was a rise of what we call micro funds. And these are venture funds that have less than 50 million total to deploy. And those micro funds tend to invest in smaller deals. So think $250,000 pre-seed checks or $1 million seed checks where they lead. They're not necessarily focusing on later stage companies. So we have this proliferation of these rise of micro funds and technology to come and accommodate them. So I'm not sure if you've heard of, roll-up vehicles or SPV online offerings, but they just, came full circle in 2021 when all these micro funds were coming out in terms of quick fund formation for these particular funds. But these funds are investing early stage. So you're still seeing a lot of activity. The third is non-traditional investors, so private equity, hedge funds, people who are in the oil and gas space in Houston, all of a sudden deciding to enter into angel investing or pre-seed investing. These non-traditional investors are also coming down earlier in the stage and trying something new. So there's a lot of really great things, to know about the U.S. financing market for your stage. One thing I will leave you with is some stats, just so that you have an idea of exactly what that would be. Here we go. So for seed and angel, for those of you who are early stage entrepreneurs, there was 5,187 deals in Q1 2022 and 3,809 deals in Q2 2022. Slight fall off, as you can see, but this is so much less significant of a drop than the 18%, that we're seeing in other later stage companies or so. So the impact of the economy right now has not quite trickled down to pre-seed, angel, seed, and Series A. It is a good time to consider coming to the US. We don't know how long this will last, and experts are being very obtuse and somewhat careful about predicting when this is going to slow down. There is, PitchBook does expect that Series A and below will be starting to be affected towards the end of the year 2022. So we'll see how that all rolls out. Now, going back to the first consideration, which is just, hey, you're coming to the US, you don't want to get venture financing. You're just here to expand your service offerings and your products and build some market revenue here in the US, perhaps even maybe to get venture financing sometime in the future. Then this is a really, really easy and quick option. It's formation of a subsidiary corporation or an LLC, if that's what works better for you tax-wise. If it's a corporation, again, super simple. You're going to file a certificate of incorporation after doing a name search. You're going to adopt some bylaws. The sole shareholder of this company is usually the foreign company. Generally speaking, we usually have the same officer director structure as the foreign entity. So the president, CEO tends to be the same, CFO tends to be the same, secretary seems to be the same. Our office or a law firm of your choice will procure you a federal tax EIN for the US to do business, and will register you in whatever state you're actually, quote, headquartered to do business, or where you do enough business such that the state requires that you register. And that's different in every state, depending on how much your product sales are, if you are a product, for example, or whether or not you're setting a virtual office that could be construed as a long-term permanent headquarters. This subsidiary formation usually allows for an intercompany services agreement as well as an IP licensing agreement if these two are not in the same agreement. And this is what happens. You have a Nigerian company abroad and you're now forming a subsidiary here in the US. And I'm doing this to indicate parent subsidiary structure. The IP lives in Africa in the parent Nigerian corporation. It needs to license that IP from Africa to the US to sub-license abroad, especially if you're deploying services in the US. So generally speaking, what this intercompany services agreement and IP licensing agreement says is that this company, the parent, Nigerian corporation, for example, will license the IP to this company, the subsidiary, in exchange for It's either a royalty fee or a profits share or some sort of flat fee, depending on how it works best with the individual tax laws that govern the interactions between the countries. In exchange, this entity, the subsidiary, will provide marketing, sales, deployment, U.S. presence, customer, support for the Nigerian parent, and handle all the U.S. business. So this structure and these two agreements allow money to go back and forth between the two entities, and as long as they're, an arm's length transaction, which means fair in the eyes of the IRS, then it allows you to shift some capital, at least to begin with, from your Nigerian entity that's presumably already funded, at least at the angel level, to the US entity to get it started. It's usually something that's from a practical reality necessary to do when you're starting a corporation in a different country. Any questions here? I'm going to take a quick pause. I know we have some lawyers also in the group, so if there's anything that you have any questions on, feel free to ask. Okay, I'll continue. Second one, this is the more complicated one. This is where you come to my office and you say, hey, Lindsay, I have a venture investor in the US. I'm on the brink of getting a term sheet. Hopefully that's the case. And they're saying that they don't want to invest in my, quote, Nigerian corporation, Ghanaian corporation, whatever the abroad entity is. They want to invest in an American Delaware C corporation, which is the usual vehicle of choice. Now, why does that happen? A lot of reasons, but generally speaking, venture funds, their LPs could be like, for example, big banks or pension funds or institutional investors that invest their funds into the venture fund and require it not to invest abroad, but rather to invest in US companies for their own tax reasons. As a result, at the early stage, especially when things are a little precarious and risky, American VC tends to prefer to invest their American dollars in a US company, preferably a Delaware C corporation. So it is not uncommon that an entrepreneur from abroad, from any country, Europe, Asia, Africa, New Zealand, Australia, we've seen it all, comes here, they try to raise venture funding and they realize that they're not organized the right way. The VC will say, well, we would only invest in an American company. Okay, what is the answer for that? You can't just necessarily, shut down your African operations. You have contracts there, you have business there. You want to keep that business open. You have technical staff there. You can't just form a new company because now you have two totally unrelated companies. How do you get the money from one to the other? What you have to do is what's called, colloquially, again, it's called a Delaware flip. Legally, it's called a reverse triangular merger. That's the doctor name for it. So the most common way that we've seen is the shareholders of the foreign entity exchange their shares for shares of the Delaware C corporation. Might be a 1-for-1 exchange, might be a different ratio. There's some question as to what are the values of the current foreign entity to date. That might be the new issue price here when we issue these shares to the foreign shareholders so that they get the quid pro quo value. There is some question, especially with Africa having many different countries in Africa, as to whether or not a particular country would be better tax-wise. So, for example, we had a consult with an African startup that was headquartered in Ghana but had different subsidiaries in 7 different African countries. And the question became, in order to do the Delaware flip and flip into the US, which country of the 8 countries in which they were based was the most tax efficient to do that transaction, right? And so that's something that might be considered at the beginning of this very complicated process is if, let's say, Nigeria is the current parent company of all the other African subs, is there a better local reorg to do before the flip into the US? Or the other option could be, is there a place to just make it add another layer of complexity? Is there a place in Europe that this African, headquarter country, parent company should flip into before flipping into the US? Ireland being one that has excellent taxes. So, for that particular company, the answer was either flipping into another African company to headquarter and parent the rest, or flipping into Ireland before flipping into the US. So this idea of do we use an existing entity? Do we create a new holding company? These are all things that you will talk with your international tax team. Generally speaking, tax lawyers can be really expensive in the US. And for early stage startups, paying $1,000 or $2,000 an hour in the US for a tax lawyer is just cost prohibitive. So what I tend to do is refer to international tax accountants, and there is a firm called Eisner Amper who has a tax lawyer on staff who charges, I think, maybe $600 an hour as opposed to $1,000, and is much more affordable in that regard. But having that tax analysis done as to whether or not this should be a new holding company, whether it should be flipping into Europe before flipping into the US, these are all important strategic conversations, because we want to ensure that how we flip your company works in terms of your tax liability in all the different places that you're operating. But going back to the, one last bullet point. Sometimes the foreign entity might even need to convert on top of relocating or re-domiciling. And that's really at the abroad level. So we had a company that was a Swiss AG, just type of entity, and it was going to flip into a Delaware C Corp. But in order to procure and obtain this thing called QSBS, Qualified Small Business Tax, we had to restructure the abroad entity, which was the AG, into what's called a GmbH, which is more similar to a Delaware C corporation. So in some cases, you're a abroad lawyer. Let's say you have a Nigerian corporation that's organized somewhat like an LLC or a partnership. It may be that they would have to, and I don't know, but speculating, it may be that they might have to flip you into another type of Nigerian entity to make that flip into the US more tax efficient. So a lot of things going on here. At this stage, what we're usually doing is having American counsel talk with Nigerian counsel or the counsel for your parent company. I know a lot of you guys are from Nigeria, so I'm assuming that many of your companies could be based here. In addition to the international tax firm, we choose Eisner Amper just because they're cost effective, but there are tons of other firms who do this work. And really planning out that schematic and diagramming it. While it takes a lot of work, we do need to figure that out before any lawyers can put pen to paper. For those of you who are, for those companies who are just not really making any traction abroad, sometimes, depending on the tax laws of that country, it's advisable to have the foreign company dissolve. And depending on the tax laws of that country, the assets will pass to the individual shareholders, who will then assign those assets to the Delaware C Corporation, and will start from scratch. So the parent company will be the Delaware C Corporation. They'll open up another entity abroad, which will be wholly owned by the Delaware C Corporation. That's only happened once to me in my entire practice, and that was with a Indian private limited company that was only open for like 3 months, and it had no traction abroad, had no debt. So this is a very unique and probably unlikely scenario. The third scenario that I've seen is usually for people who are pretty well off. We had a company who had opened up an Indian company, but the founders lived here in Silicon Valley, and they invested something like $300,000 into their Delaware C Corporation to allow the Delaware C Corporation to just purchase their shares from them. They then put that money on a note. Something advised by their CFO advisor. It wasn't necessarily something that I had thought of myself, but that was only contingent on them having the amount of money to purchase their abroad company from themselves through their Delaware C Corporation. So these are the other options, these next 2 bullet points that I've seen. Immigration concerns. Now that we actually have learned in the pandemic that you can operate a company, and VCs have learned they can tell you how to operate your company from Zoom, VCs are a little less inclined to necessarily require that the C-level officers live here. Previous to the pandemic, it was pretty understood that the C-level officers need to be in the US, their families need to immigrate here, and that the VCs, as a part of that funding, would pay for all the immigration issues that would follow, right? Which are complex. If any of you need an immigration lawyer, I'm happy to refer you to that person. Now, even with a recent Series A funding, the investors did not require the founder to leave his country of record to come to the US on a permanent basis. It's not necessarily as much of a requirement as it was before. So it is possible that even after you get financing, if you would like to stay in your home country as opposed to come to the US, I know we have so many problems right now, you may have an argument that you can stay in your home country if you'd like to. Okay, so I went over this a little bit about the complexity on the tax end. We are not tax counsel. We refer to tax lawyers or a very experienced international tax accountants for this basis, but that is one of the hugest considerations, kind of touching upon bullet point 3 on this slide, valuation of the foreign business IP for sale, transfer pricing analysis for IP licensing, and international tax issues. These sorts of, this third bullet point is going to be the make or break as to whether or not this is affordable for your business in light of the money being raised. The other things, which are less make or break, are necessary third party or investor consents on the foreign entity side in order to do this procedure. We did have a client who had a bank who was an investor in his home country, which was not allowed to hold shares of an American entity. So that almost barred the transaction absent the company repurchasing those shares after the flip and the raise. It was a very big sticking point for that investor. So if you have institutional investors in Africa in your company, you need to make sure that you go through their investment contracts or any contracts you have with third parties to make sure that this procedure, these contracts can be assigned with an assignment clause, or that the necessary consents are received. And that's really something that your foreign counsel, so that the Nigerian lawyer or the parent company's lawyer can do. They have direct knowledge of the company, so they're able to take a look into those existing contracts and make sure that this procedure is allowed. Of course, there will be consents for the foreign entity and the Delaware C Corp to approve this transaction. That's a lawyer job, nothing necessarily that entrepreneurs need to do, but something that will need to be done in order for this transaction to go through. And finally, the fourth bullet point, license or sell the property, the IP. Now, in your case, if the IP lives in Nigeria, or any abroad country, there are some issues with exporting IP in some countries, and also the cost and the taxes of transferring that IP from the abroad country to the US. Venture firms typically prefer that the IP belong or is housed in the Delaware C Corporation, the entity in which they're investing their money, right? And that makes sense at a really early stage. You don't have any real estate, you don't have any collateral for this investment. This is like the sole crux of the value, the quid pro quo, so to say, that they're giving you this money, you're giving them this entity with IP that's valuable. So they prefer it to be here. The question becomes, in some countries, what are the export laws as to that IP? What are the tax implications of selling that IP from that country to the other country? Does it, again, require any kind of flipping into other countries or flipping into Europe in order to make those tax ramifications less? It is something that you have to consider before undertaking this transaction, because it's something that can be very complex and actually end up costing you more money or costing you more money than you want to spend, in addition to legal and accounting fees in light of your raise. So these are all the preliminary considerations. Then we incorporate the shell of the company and we accomplish this flip. Very similar types of documents here. Again, now we have the Delaware company in the US as the parent, and the presumably, let's use Nigerian company, corporation or limited liability company as a subsidiary. We incorporate the shell, we adopt bylaws, we do the share exchange agreement so that the shareholders of the Nigerian company can exchange their shares for the shares of the Delaware C Corporation. So now that the Nigerian shareholders are at the top of the pyramid, followed by the Delaware C Corporation, followed by the Nigerian entity. There's usually what's called a restricted stock agreement that comes out at the same time. In the States, usually we subject founders to like a 4-1 vesting schedule, something very common here, and we can talk more about that if you have any questions, but it's a pretty familiar term. There's usually some sort of NDA, an assignment agreement in exchange for shares. In some jurisdictions, maybe a non-compete. Again, same agreements before: intercompany services and IP licensing agreement, an IP sale agreement that we've talked about earlier. Especially with this flip, the sale agreement needs to come first to allow the IP to be transferred from the abroad entity to the US entity, and then the licensing agreement will allow that that IP to be licensed back to the abroad entity for sub-licensing abroad. So similar documents, but just a lot more moving parts. I'm going to turn it over to Jason because I'm going to let him talk a little bit more about the venture funding life cycle, and so that you guys have an idea of what's available here in the US and how normally US-based startups go about doing their financing raise.
Good evening, everyone. My name is Jason Crane, and I'm an attorney at Smith Superior and Mignano. And my focus has been for a number of years on representing startup companies, tech-based startup companies that are pursuing venture capital, which sounds like a real niche, and it is kind of a niche. There's lots of companies out there doing lots of different things, but tech-based VC-funded startups is a very particular flavor of those, and that's what we're here to talk about. So the first thing you need to think about with starting a company or moving a company to the United States is how exactly is that company going to pay its bills and pay its people and develop its technology. It needs funding. And so there's kind of a various buckets of funding that the startups will go through. Some skip several of them, some do a few of them. But I want to just kind of talk briefly about the funding life cycle. And then I'll drill down a little bit in the next few slides on some of the specifics of these different types of funding cycles. And then I'm going to spend a lot more time talking about venture capital financings. And in that sense, at that point, I'll drill down pretty deep into what those look like. So that's kind of how we're going to start, is the funding life cycle is that companies will and entrepreneurs will, and this may have occurred long before the flip into the United States, but there's a time period where there's a self-funding. Sometimes entrepreneurs are working in another company and they've got an idea that they want to start. There's dangers in doing that, but somehow, sometimes the way they're self-funding is that they've got an income stream coming in from somewhere else for the time being. Sometimes they've saved money and they've left their employer and now they're starting their new company, and they pay the bills initially through their own monies. But at some point, that's going to be exhausted or not be all that desirable. And startups will go out to friends and family. And these are close acquaintances, and you're raising small amounts of money to start to really get into developing the technology, to putting pieces in place to have a company. And the next flavor of that, and it's similar, is angel funding. These are generally high net worth people or networks of high net worth people who will put generally greater dollars in than came through friends and family. But as you'll see in a subsequent slide, the way in which they do it is typically the same. After that, or at some point later, there may be crowdfunding. That's actually very uncommon, but I put it on here because it is a source of funding. Crowdfunding would be something like Seed Invest or Kickstarter. Kickstarter being a way in which you pre-sell some of your products. Seed Invest is a way in which you take advantage of a relatively new body of law in the US that lets you more broadly sell securities in your company. But again, not a lot of companies do either. They generally jump from angels to venture capital. And venture capital is venture capital firms. These are firms organized where they get a bunch of limited partners who have a lot of money. These are high net worths. These are sovereign wealth funds. These are other entities that have a fair amount of money that they want to deploy into venture capital, into high risk, high reward sort of investments. And your Kleiner Perkins and Sequoias and Bessemers and other big venture capital funds and lesser sized venture capital funds have managers, VC partners, who vet and ultimately make the investments and then manage the portfolio companies. This can happen for a number of rounds, and those rounds tend to have a nomenclature. Legally, there's nothing significant about the nomenclature except you need to have some name, and those names generally break on the following convention. Your first round is typically a Series Seed preferred stock, and after that you have a Series A and then a Series B and so on and so forth. Sometimes you'll have a few flavors of the same series, such that you'll have a Series 1 and a Series Seed 1, a Series Seed 2, a Series Seed 3. Again, legally, there's nothing too significant about that. But you can have at the same time, or as opposed to venture capital funds making purchases of your preferred stock, you can have strategics. And that's actually a lot more these days than there had been, say, 15 years ago. Strategics are corporations that are typically in the same space that the startup is pursuing, and they make an investment in the startup somewhat for a return on that investment, but typically more involved in some sort of strategic relationship. Perhaps they'll be a customer, perhaps and naturally one thinks of them as a possible acquirer at some future point. Sometimes it's to keep a finger on the pulse of what's happening in the market, but strategics are a major player in the venture capital world. You can also sometimes have funding coming in from a bank. That's very uncommon in the early stages. It's typically a post-Series A sort of event, but you can have a term loan or you can have an AR factoring loan. And these can come from banks, and there's some other institutions that are making this lending available. But again, it's not really common in the early going. The idea that you would get like a small business loan and start a technology-based startup, it just doesn't really happen. After that, private equity, which feels a lot like venture capital. They're buying shares of preferred stock, but they're different institutions and they're looking at much more mature companies. And then finally, if it's in the cards, a company will ultimately go public and sell their shares on the NASDAQ or the New York Stock Exchange, here in the United States. So on the next slide, I'm going to drill into the friends and family and angel rounds. So these tend to happen through one of two things. You can either have a safe or you can have a note. And they're actually very similar documents. There's a few differences between them, but they operate much the same way. So let me talk first about safes, and then I'll get into notes and just kind of highlight the differences. So first off, safes. These are uniform documents that were generated by Y Combinator. Their counsel Oric drafted the documents, which are very ubiquitous now in the market. People don't have various flavors of safes. They have the Y Combinator safes. Now, the Y Combinator safes are not debt, so it's not a obligation that the company need repay. There's no maturity date. There's no interest. It's in essence what the name is, which is a simple agreement for future equity. That's what a safe actually stands for. So I'm pre-buying a series of your preferred stock when you ultimately have a financing. That's what a safe does. And so that is the fact that it converts at the next round of funding. Your safes will stay on the books until you close your Series Seed or your Series A financing. You can have safes being sold prior to your first venture capital raise. You can also have them being sold between Series A and Series B. That's less common. But your friends and family, those are always prior to your Series A. Angels are prior to your Series A. So why would anyone put money in now in the hopes that you'll ultimately have a venture capital financing? The reason is that there's some sweetener for them to do that. And the sweeteners are I'll jump first to discount. A discount is that if you sell your Series A at $1 a share and you get a 15% discount, you're going to be getting your shares, the safe investor will, at 85 cents a share. It's just a straight discount against the price per share that's being sold in the next round of venture capital financing. A valuation cap is a little bit more complex, but it in theory is somewhat simple. You basically are setting a cap on what the valuation will be at the next round, and the safe investor is getting their shares of Series A or Series Seed as though the valuation at the time of that financing, that venture capital financing, was whatever is the cap in the safe. Again, that's a little bit more complex. The math certainly is than a discount. But for instance, if the valuation cap is $1 million and someone's investing $10,000 in your company, then the math at that point is somewhat simple in the current version of SAFE. The current version of SAFE would say that the person owns, as of now, $10,000 over $1 million, or 1% of your company. And then you'll also have a type of safe that doesn't have a sweetener. It doesn't have a cap. It doesn't have a discount, but it does have a most favored nation clause, which is a slang term to say that whatever the next version or any subsequent version of safe might be, if it has a discount or a valuation cap, then the safe investor is going to get the benefit of that. Okay, so that's a safe. A note is different in the sense that it is debt. It does have a maturity date. It does have interest. But one thing that's quite different about a note is that there's no standard in the market. It's not as though an entity like Y Combinator put out its version of safe and everybody uses it. Notes are different from instance to instance, and you will find that those tend to be documents that are particular to a given law firm. So Wilson Sonsini, which is a big firm in the Bay Area for startups, they may have a type of note that is different than, say, another firm here or anywhere for what they're using for pre-venture capital financings. But like a safe, notes convert at the next round. That's the idea. They're called convertible notes, and the reason being that they actually convert. And they have the same sort of sweeteners, valuation caps or discounts. And so on the next slide, I want to get into the venture capital financing. And we're going to spend the rest of the conversation talking about a VC financing. So how does one go about getting a term sheet? There's a few steps in the process until you actually get the term sheet to you. And the first one is that you have to get introductions to and pitch a number of investors. That's super easy to say, right? But not so easy to do. Getting in front of VC investors is challenging. That's totally understood. But that's how one does it. Cold emails in across the desk of a VC, by and large, don't get much in the way of a response. Every once in a while they do. I've got a client who sent a number of them and they did get a few responses. Most often, though, they got no response. But it does happen from time to time. But getting a warm introduction to a VC is far better. So then if you pitch an investor and they're interested in the idea that you've described, then they're going to start digging in and performing some business diligence. That typically takes several weeks. Every once in a while, you hear stories about an investor who got pitched, loved the idea so much, they said, I'm going to have a term sheet for you, or they just give you the economics now. And that does from time to time happen, but it's super rare. Typically, investors really need to dig in. They owe it to their LPs to do their diligence before they deploy their LPs' money. So it'll typically occur over several meetings. There'll be the first initial meeting with the VC. Sometimes it's with a principal of the VC, which is not a partner. It's someone that works for a partner. But if you make it past that, then you start having more meetings. Generally, there is one final meeting with the entire partnership where you're pitching the whole team. because generally it is a partnership decision whether or not to invest. It's not just one partner's, and that partner who has been the main lead in the conversation is the advocate at the firm for let's make this investment, and then all the other investors, all the other partners rather, try to typically poke holes in it. But then the process is going on, and while it's going on with one investor, ideally the entrepreneur has the same process going on with one or more other investors. And the challenge becomes trying to keep those paced such that they're all coming to a head around the same time. That's the perfect scenario where you've got multiple term sheets that you can receive at the same time and start to create a little bit of a seller's market. As I mentioned, there's a final partnership meeting before approval, and then the partners will extend the term sheets. So in the next slide, I'm going to talk about the key terms in any Series A, Series C term sheet. And so these are large categories of terms, and then I'm going to drill down into what each of these categories really means. So the key term that you think about is the economics. How much am I going to get of your company for how much I'm giving you? The next very important point for any VC is what sort of controls am I going to have in the company? We'll get into that in a sec. The next category, which the VC tends to be a little bit less focused on, although it's super important, and there's standard terms in market that they often just defer to, but that's the rights, preferences, and privileges of the series of preferred stock that they're buying. I'll get into the details on that in a second. And then finally, beyond just those rights, preferences, and privileges, there's some extra rights that investors will get in the company. And so I'll get into that as well. But first, let's start on the next slide, which is the economics. So the economics, I'm going to dive into a little bit of math here for a second, so bear with me. There's three things that really matter in determining the ownership. The first two will actually tell the investor how much they're getting of the company. The third will tell the founders how much they're being diluted. So the terms that you'll hear is the amount that's being invested and the pre-money valuation. These work in the following way. The ownership that I'm going to own of your company as an investor is going to equal how much I'm giving you divided by the pre-money valuation plus how much I'm giving you. So another way of saying is that I'm going to value the company at 80 million, and I'm going to give you $25 million. Or let's make it easier. Let's say 20 million. So I'm giving you 20 million on a pre-money of 80. So that's going to equal 20% of the company. And here's how I got that. It's 20 divided by the 80 that I valued the company at, plus the 20 I'm giving you. Or said another way, after this round, the company's worth 100 million. It's worth the 80 that I said it was, and it's worth the 20 that you now have sitting in the bank. So that's 20 over 100. The other term, though, that I described is this term that's going to also go into the math. It doesn't change how much the investor is going to own, but it does speak to how much additional dilution is going to occur for the people that are currently on the cap table. And that is, what is the percentage of the post-closing company that is made up by the option pool? And the option pool is the reserve of shares for granting to service providers like employees, board members, and advisors and consultants. And so if the company is going to have a post-closing option pool of 10%, then that's additional dilution, the additional shares that have to be created and reserved. And so that is an important economic term as well. Investors want that to be fairly large. They don't want it to be so large that it disincentivizes the founders, but they want it to be large enough to where that wouldn't need to be increased before the next round. So how do you determine the investment amount, the pre-money, the post-money option pool? They're all the negotiation that you have with the investor. There's some effort in the investment amount to try to put a dollar against it to get the company to the next stage of its growth, the next kind of milestone that would make the next round of funding more feasible and at a better valuation. The pre-money valuation, there's some effort by the investor to evaluate the company and try to look at its technology to the market and its financials, if it's revenues, if it has any, and try to come up with some logic for why it's worth what it's worth. And the post-closing option pool, as I described, is trying to look at your hiring plan and make sure that you're not going to have to increase it. In practice, what happens is that investors have a certain amount of money they need to deploy. Some are not interested in deploying 1 million. They want to deploy 10. And they don't want to have less than X percent, but they don't want to over dilute the company and take 50%, 60%. So there becomes a natural band based on that as to what the pre-money is going to be worth. And then the final thing I'll note is that the safes and notes that we talked about in the previous round, they convert in this round. And so they're further dilution, but they don't dilute the new money. So in the next slide, I want to talk about the control issues. So in the control of the company from an investor's perspective, they're going to break on 4 issues. The first one is that the lead investor, and a VC round is typically comprised of one lead and several following investors. Some VCs tend to only follow, some will follow and lead. But one is going to be the lead, and that VC is going to expect a board seat. And there's going to be some additional terms that talk about what the company must get approval of the board to do. There's some issues, and really not too many, under Delaware law that the board has to approve. Things like securities issuances, the board has to approve. Sales of the company, the board has to approve. But there's not a long laundry list of other things the board needs to approve. There's just standard convention. But the board voting requirements create a contractual obligation that the company has to not do things like take out a loan for more than $50,000 without getting board approval. But it goes on and it's more specific. It says you can't do this without board approval, and that board approval must include the investor director. That's a control that the investor director is going to get in nearly all venture capital financings. The next point is voting thresholds. And these are now talking about stockholder votes. Is it just a simple majority that's required to do certain actions, or is it a supermajority? And then finally, there's tends to be a list of things that are hardwired into the company's charter, which is the document that's filed in Delaware and becomes law for the company and its operations, of a list of things that it cannot do without stockholder approval, just like the list of things it can't do without board approval. And here's a list of some. This is a long list, and a lot of companies don't have all of these, but I wanted to just include a few just so you could see. I'm not going to step through those. Okay, in the next slide, I'm going to talk about the rights, preferences, and privileges of the preferred stock. And these are always contained in the charter, the document I described that is filed in Delaware. And so the first is dividends. Does the preferred stock get any preference in its dividends over the common stock? Typically, yes. It won't. You can't pay common stock dividends unless you pay them on preferred stock. One thing I want to just highlight, though, is that dividends in technology-based VC-funded startups are very, very rare. It's a term that you need to have to protect the investors from having dividends, but by and large, tech startups don't do dividends. The next one is liquidation preference, a very important term, one that the VC, the partner, will get pretty involved in, and that is if there is an exit of the company, a sale of the company, and that sale is not a very exciting one, there's not a lot of money to go around, the liquidation preference talks about who gets that limited amount of money. And there will always be a liquidation preference. One of the reasons there always is a liquidation preference is that, say, in my example before, where I said that the investors are going to own 20% of the company and they've given the company 20 million. If the founders own, say, 60% of that company, then there would potentially be an incentive for those founders to just go ahead and dissolve the company, and they get 60% of the 20 million. Clearly, a sort of activity that wouldn't be tolerated. And so a liquidation preference is part of the way that investors protect against that occurring. The voting rights also help. But the liquidation preference is typically along the lines of 1 times the amount that the investors purchase the shares at. So if it's $1 a share, then their liquidation preference is $1 per share. The market's turned a bit, and you're starting to see some pressure on that norm. And investors are starting to ask for greater than 1x preference. And they're also starting to ask for something called participating preferred, which means that they get their 1x and then they also participate in any additional amount of money distributed out pro rata. That's going back a while ago to like when the dot-com bubble burst or when there was the housing crisis here in the US. Those were times when investors had fairly sharp terms, and those are deemed sharp. Voting rights are what I previously described, the protective provisions. Conversion and anti-dilution, preferred stock always converts into common stock. Anti-dilution is a way in which you can adjust the conversion ratio from the standard 1-to-1 share to something like 1 to maybe 1.2 shares. And that kicks in the event that I funded the company on my 80 million pre, and then you go ahead and you do another round of financing on a 60 million pre. Well, that's a down round, a lower valuation, and I'll get anti-dilution protections. Redemption is the right that the investor has to make the company buy back its shares. Very uncommon. And then finally, if there's more than one series of preferred stock, if there was a Series C and we're now doing the Series A, then the question becomes, is the Series A have a preference over the Series Seed? So I'm going to move a little more quickly into the next 2 slides. The next one talks about the investor rights. So these are contained in other agreements that get signed at the same time as the actual charter is filed. And I'll talk about what those agreements are in just a minute. But the rights that the investors will also get are registration rights. They'll always get that. That's the ability to force the company to go public. It used to be a very hotly contested body of rights. And it's not as much anymore because there's a recognition that companies, even if the investors say you must go public, they can't go public if they're not ready and there's no underwriter willing to take them public. So but the terms are always still there. And there's some other portions of registration rights that are still important, like what happens after it goes public. The next body of rights is what's called major investor rights. Not every investor gets these. These are investors who invest above some threshold. That threshold is somewhat negotiated. The investors don't care as much. It's mainly the founders that want to put that at such a level that they can potentially get investors to stretch a little bit. Not the lead, they'll always get major investor rights, but some of the followers, you want to set that high enough to maybe get them to push a little further in the size of their round than they were going to do. But those rights are information and inspection rights. Information rights is the rights to get financials delivered to you. And then pro rata rights, which is the right to invest in the next round of funding. And then there's usually a kind of a batch of different covenants that the company must do. Obtain D&O insurance, certain things about employee agreements, and so on and so forth. I won't dive into these too deeply. But this is a collection of common ones. You sometimes have all, you sometimes have a few. And then finally, the other body of rights is what's called a right of first refusal and a co-sale. And this applies to any transfer attempts by founders. Right of first refusal says that if a founder wants to sell some of the founder's shares, the investors have a right to buy them. Co-sale says that if the founders want to sell some of their shares, the investors have a right to sell alongside, cutting back the founder's number of shares. And then on the last slide, this is the collection of documents that are drafted and signed and filed in connection with a round of funding. It's the certificate of incorporation, which I used the term charter to describe, the stock purchase agreement, investors' rights agreement, right of first refusal and co-sale agreement, and voting agreement. Those are the body of documents that get negotiated and signed. In addition to that, there's a board and a stockholder consent that's required. There's a disclosure schedule, which is kind of listing out all the company's dirty laundry or just some details about the company all in one doc so that investors can review it and quickly see if there's something that they need to dive into a little deeper. And then oftentimes there'll be a legal opinion by the company's counsel. The process is to get all those drafted and negotiated in final form, then solicit board and stockholder consent, file the charter, exchange signatures, wire funds, and then you have your closing. So that's the funding life cycle, the different types of fundings, and a lot more detail about venture capital financings. We're close to out of time, but I'm certainly happy, and I'm certain Lindsay's happy to stay on and answer any questions you might have.
Yeah. Thank you so much. Thank you so much, Jason. That was very enlightening. And Lindsay, I had a lot of questions, but it seems you read my mind, because you read my mind before this session when I went through the slides. So you answered a lot of them, but I still have a few for the sake of the audience, especially those who are just looking to go into the US for the purpose of just assessing the American market, not necessarily raising funds from VCs. So you mentioned a lot about Delaware, C Corp, and all, and I'm sure a lot of them will be wondering why Delaware. Aren't there other states? Must it be Delaware? So why Delaware?
Yeah, absolutely. So there's a lot of reasons why companies choose Delaware in the US. It's considered the gold standard in terms of its corporate law. It's considered generally the fastest to process and file a certificate of incorporation or certificate of amendment, any kind of corporate filings to get a company birthed in the US. Additionally, if there are any disputes in the Delaware is the state of incorporation, jurisdiction can lie proper in Delaware as a choice of law and venue. And there's a lot of really great precedent by the Court of Chancery in Delaware for resolving business and contractual disputes. So there's a lot of reasons why Delaware. For US companies, for foreign companies seeking to set up a US subsidiary, but who might flip in at a later date, sometimes having that subsidiary be in Delaware is helpful, so that we can rearrange the structure from instead of Nigerian parent and Delaware C Corp subsidiary, we can rearrange it, flip it later on into Delaware parent and Nigerian subsidiary. Being in Delaware is sometimes convenient. Of course, that really just depends on whether or not there are going to be other blocker corporations. So it really just depends. That being said, I would say a lot of people tend to prefer Delaware for pure optics more than anything else. Sometimes I'll tell clients, you could set up your subsidiary in California or New York or Massachusetts, wherever you're headquartered, technically speaking, but they prefer the kind of name branding, national branding that Delaware provides. So it's really, at the end of the day, somewhat esoteric and academic until you get to the point where you want to flip the company. I think we lost her. Cynthia?
Yeah, she was cutting in and out earlier.
Jason, do you have anything to add? I'm sorry, please,
With respect to Delaware, no. I think you covered it really well. I think investors see it as a more investor-friendly board, has more protections, and investors are sitting on the board, so they're very interested in that. But you're absolutely right. The Court of Chancery has really established itself as the gold standard for corporate law. A lot of other states don't have a particular court that's focused solely on corporation law, like California doesn't. Delaware has a court, the Court of Chancery, which does nothing but corporate law.
Yeah. So for that reason, it's an academic argument at best, but it can be more convenient if we use that vehicle later to flip as well.
Yeah.
So all good questions. I know I'm going to wait for Cynthia to pop back in. I think maybe she's having an awkward internet connection. Does anyone have any other questions we can answer? I know that we have a number of you in the chat from Nigeria. Anything specific there? Well,
no, we can't see if anyone's typing, but
no, we can't see if anyone's. Oh, here we go. Delaware said yes. Delaware is investment friendly. That's true.
yeah, it is.
We're going to just give a few more minutes for Cynthia to come back in. One question: can you register as a sole proprietor in the U.S.? You can, but if you're a sole proprietor, that means you're doing business individually, and no one can invest in you as an individual, right? Because if you want investment, you may want to set up an entity in the U.S. In order to sell shares of that entity and receive investment money. It's hard to register as a sole proprietor if that's a vehicle that you want to use to do investment. If you want to, Tishan, is that question related to subsidiary formation or expansion of the business into the U.S. or related to investment? Let me ask a clarifying question. And we can't tell if you're typing, but I'll drop some other quick updates in stats while we wait for Cynthia to come back.
Expansion to the U.S.
Oh, expansion to the U.S. Okay. So Tishan, do you have an entity abroad? Because generally speaking, what we would see is that you have this entity abroad and you set up an entity here so that entity can license its IP of the tech company abroad to the entity here to sublicense abroad. Are you saying that the entity abroad would license its IP to you individually, who would then license the IP here in the US? If so, I think that opens you up to some personal liability issues, Tishan, just because as a sole proprietor, you have no entity really blocking you from, for example, liability for breach of contract. You want to make sure that you have an entity there. If you're licensing your abroad IP to anyone in the US, I would assume for you, you'd want to have that entity to protect yourself. So licensing it to an entity to sublicense in the US might be the most protective way than you sublicensing it under your own personal name and having your personal assets exposed. Vivian, for those interested in foreign investments in Delaware, how long does it take a company and how much does it cost on average? If you are an entrepreneur who wants to get American VC financing, and that's your ultimate goal, you don't have to be living here or present here to open up a Delaware C corporation. In fact, it's very simple to do that. Most law firms will charge about $2,000, $3,000 to do that. My only caveat is that if you have an entity abroad, that's not quite the right way to do it. So Vivian, if you have an entity in Nigeria that owns the IP, you can't just form a new company here in the US from scratch for $2,000 or $3,000 because that IP lives abroad in the abroad entity, and we need to get it over to the US entity. So usually the share for share exchange and the IP transfer accomplishes that during the flip. If you have no entity abroad, you are an entrepreneur in Nigeria who has no entity abroad that houses the IP that you create in your mind or on a napkin, and it's a very early stage idea, then you technically could open up a Delaware C corporation from scratch, $2,000, $3,000 in the US for attorney's fees. Form that, assign the IP from yourself as the individual to the company. It's an IRS 351 transfer, which means it's tax-free here. And then start the company here Again, you do not have to be a citizen or a resident of the US to start a company here. We help foreign companies do that all the time. That would be the most ideal situation. If you start the company here and then you open up the subsidiary in Africa, in one of the countries that is tax efficient with the tax treaty between US and that particular country, choose the best one to have that your African subsidiary, and then have that, whatever that country might be for you, and depending on where you're operating, then either open up sub-subsidiaries or do business in the other countries. That would be the most efficient if you can swing it, if you have not already opened up an entity abroad that owns the IP that you've created. Any other questions? One thing to note, just for the stats, since some of you might be angel or seed fundraising, is that angel funding is up in deal size this year. It's a 33% growth in median deal size for angel investment, up by 1 million from 2021. This is the only investor see a positive change this year. And interestingly enough, the area in the US where this is happening the most is Denver. Denver was up by 1 billion quarter over quarter this year, marking an 111% jump. And a lot of that is an angel and pre-seed and seed financing due to the hot Denver venture and angel market. So for those of you looking to come to the US and you are looking for something that's 500,000 or maybe 1 million, it appears statistically that Denver is the place to be. Cynthia, any other questions before we toggle off? It doesn't seem like we've got any in the chat.
Okay, thank you. So, Mr. Jason, just a word of advice, your final word of advice for African startups looking to get funding into the international market, into the US market. What's your final word of advice from experience?
Yeah, from experience is, and I think it's advice generally for any entrepreneur, which is that it's scary to suddenly dive in both feet head first into the idea of working for yourself in the formation of a company. But the only way to do it is to just jump in and do it. And I would advise anyone who's thinking about doing it to take the plunge and run with it with everything you got. And there's not legal advice, but that's my advice to any entrepreneur.
Okay, thank you so much. Thank you so much for having us here, and thank you for sharing. So I didn't expect this. This is very valuable, and I'm sure that a lot of persons who will be watching this video will gain a lot from it. I mean, and you're just doing this for free. I really appreciate this. And there's so much to talk about. Personally, I think there's so much to talk about when it comes to doing business in the US. And I hope to have you here some other time to talk more about this, especially in terms of structure, because I have come across a lot of startups who have been making inquiries in this regard. And there seems to be some kind of confusion in that regard. And so having the presence of experts who are thriving in the US market professionally to come in to advise in this regard, it will be very, very valuable. And so I look forward to having you some other time, hopefully, if Lindsay will oblige me and Jason too. And thank you so much. Thank you. Thank you.
Absolutely. Thank you for having us.
Definitely.
Thank you. Thank you. Bye.
Bye.
All right. Thank you, everyone, for joining us on this session. And the video will be left here for the purpose of those who want to see this in the future. And if you have questions, you can also send them to me privately, and I could also have it forwarded to Jason and Lindsay. So thank you for staying in, and thank you for tuning in. Until I come your way some other time. Thank you. My name is Cynthia Tishon, and have a nice day. Bye.